degree. The Chinese leader Xi Jinping arrived on Tuesday in Wuhan, visiting the center of the global coronavirus epidemic for the first time since the outbreak began and sending a powerful signal that the government believes the worst of the national emergency is over. Mr. Xiao's visit was reported in a brief bulletin from Xinhua, the main official news agency, which said he met with frontline medical workers, military personnel, community workers, police officers, and officials. His trip is sure to be seen as a sign that China's leaders believe that a series of draconian restrictions, including the lockdown of hundreds of millions of people starting in late January, have brought the outbreak under control. According to official data, coronavirus infections have recently receded in China, falling to a few dozen new cases every day, nearly all of them in Wuhan, the provincial capital. On Tuesday, China said it recorded 19 new infections from the coronavirus, and 17 deaths, in the past 24 hours. All but 2 of the newly confirmed infections were in Wuhan, the central Chinese city where the virus originated. The remaining 2 infections were people who contracted the virus after traveling abroad. Wuhan remains the source of most new infections, even as the overall number of cases has fallen. More than 3/4 of the 3,136 deaths recorded in China were in the city of 11 million people. In Wuhan, most residents remain under heavy restrictions. But growing numbers of neighborhoods across the city have been declared free of new infections, and officials have said that the last 2 makeshift isolation centers for patients with mild cases of coronavirus infection would close. The Italian government on Monday night extended restrictions on personal movement and public events to the entire country in a desperate effort to stem the coronavirus outbreak, an extraordinary set of measures in a modern democracy that values individual freedoms. Get an informed guide to the global outbreak with our daily coronavirus newsletter. Prime Minister Giuseppe Conte announced in a primetime news conference that public gatherings were banned and that people would be allowed to travel only for work or for emergencies. Those restrictions had been placed on the red zone created in northern Italy, covering about 16 million people, but Mr. Conte extended them to an entire nation of 60 million. We all have to renounce something for the good of Italy, said Mr. Conte, saying that the government would enact more stringent rules over the entire Italian peninsula. Italy has recorded more than 9,000 coronavirus infections and 463 deaths, well over half the toll for Europe, and the numbers continue to climb fast. While the coronavirus prompts shutdowns and economic alarm across the world, the Chinese province where the epidemic began announced that it would avert manufacturing supply chains as well as travel. Consumer spending would fall and businesses would falter, and stock prices would plummet. The threat to corporate profits would send investors in search of safe havens, like government bonds, sending those prices up and their yields down, in turn straining the banking industry. Banks would limit financing for businesses, which would cut production or lay off workers to hoard capital. Already, investors have hustled to safety, shunning corporate bonds and driving up the financing costs for many companies. And as they piled into U.S. government bonds, long-term interest rates fell to historic lows. Benchmark 10-year Treasury bonds, whose interest rates until last week had never sunk below 1%, were recently yielding half that. Hoping to forestall that spiral, the Federal Reserve on Monday said it would increase the volume of short-term loans available to banks to make it easier for them to continue lending. It was the second time in a week after an emergency interest rate cut last Tuesday that the Fed had moved to stem potential fallout as the coronavirus sent markets gyrating. Even for people who don't have money in the markets, the developments are ominous. Large and small businesses hire or fire workers and buy equipment and raw materials based on their own financial strength and their expectations for how the economy will perform in the future. As companies retrench, it affects workers and suppliers, which then have to tighten their own belts. Layoffs rise, wages decline. Consumers spend less. Businesses in need of cash would normally turn to their banks for help in moments like this. But as banks get squeezed by sliding interest rates, their ability and appetite to lend to struggling companies diminish. The type of situation the Fed was trying to head off by increasing its short-term lending. At the same time, panicky investors want to buy risky corporate debt, severing another potential lifeline for many companies. Investors are also yanking their money from mutual funds that invest in leveraged loans, a risky type of corporate debt that has become a popular way for many companies to finance their operations in recent years. Investors are pulling money out of mutual funds that invest in leveraged loans. Investments in and withdrawals from leveraged loan mutual funds. Plus $2 billion. Weekly. Plus 1. 0. 1. 2. March 4th. 3. $23 billion. 4. 10. 11. 12. 13. 14. 15. 16. 17. 18. 19. 20. Investments in and withdrawals from leveraged loan mutual funds. Plus $2 billion. Weekly. March 4th. $23 billion. Plus 1. 0. 1. 2. 3. 4. 10. 11. 12. 13. 14. 15. 16. 17. 18. 19. 20. Source: Refinitiv. By the New York Times. The result could be a surge in bankruptcies as companies, in particular in the shale industry, where many drillers are deep in debt, tip over a financial cliff. More workers lose their jobs. Families cancel vacations and postpone big purchases. Round and round the cycle goes, further sapping the economy. Markets want to hear that the global economy is open for business, and the problem is, it isn't easy to say that going forward, said Patrick Chovanec, chief strategist at the investment advisory firm Silvercrest Asset Management. It is possible, of course, that investor gloom will prove to be overblown. At some point, for example, the coronavirus is likely to stop spreading. It already appears to be easing in China and South Korea. If that happens soon, any economic damage from closed factories and cancelled conferences and restricted travel may prove fleeting. Perhaps Russia and Saudi Arabia will quickly reach an agreement. And until they do, there is a silver lining to rock-bottom oil prices. The resulting cheap fuel will be a boon to consumers and to industries like trucking and airlines. All is not lost. Even after the decline on Monday, the S&P is still up 140% over the last 10 years. And the scorching bond market rally, bond prices go up as yields go down, has delivered outsized returns to many individual investors. Mutual funds and ETFs holding longer-term U.S. government bonds were up 22% so far this year as of Friday, according to Morningstar. In addition, low interest rates are good for people who own or are looking to buy a home. A mortgage refinancing boom is underway, and many borrowers will pocket substantial monthly savings. An index of mortgage refinance applications, which tracks week-over-week increases, has surged since the start of this year. Mortgage Refinance Applications Index 6.0005. February 28. 3594. 4. 3. 2. 1. 0. 10. 11. 12. 13. 14. 15. 16. 17. 18. 19. 20. Mortgage Refinance Applications Index 6.0005. February 28. 3594. 4. 3. 2. 1. 0. 10. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Source: Mortgage Bankers Association. By the New York Times. This is a temporary headwind to the economy, said Rick Reeder, Chief Investment Officer of Global Fixed Income at BlackRock. It's temporary, but it's a tornado-like headwind, so it's going to be powerful for a period of time. He added that the amount of uncertainty in the markets is higher now than it was at the peak of the financial crisis. I don't even remember in 2009 the uncertainty being so high, he said. Governments and central banks are scrambling to defuse the precarious financial situation. In addition to the Fed cutting interest rates and making it easier for banks to borrow money, the Trump administration and Congress are discussing ways to stimulate the economy. But that is unlikely to offer much immediate help. Many investors are anticipating fiscal stimulus within days, but that's not typically how DC acts even in emergency situations. Henrietta Treyes, Director of Economic Policy at Veda Partners, an investment advisory and consulting firm in Bethesda, MD, said in a note to clients on Monday. It takes weeks to pass even the most urgent of legislation, and there are very few ideas circulating on Capitol Hill right now. In the meantime, the signs of stress are multiplying, especially in normally mundane corners of the financial markets. In recent days, for instance, investors that buy ultra-short-term debt issued by companies including a popular variety known as commercial paper have started growing jumpy. Investors like money market mutual funds are demanding much higher interest rates. That drives up many companies' borrowing costs, which makes it more expensive for them to operate. It also shows that institutional investors fear that an increase in corporate defaults could be imminent. The good news is that the U.S. banking industry is, overall, much stronger than it was in 2008 as an intense financial crisis enveloped the world. The energy industry, though, is shaping up to be among the hardest hit sections of the U.S. economy. Demand for energy was already set to decline with an economic slowdown. Then Saudi Arabia and Russia initiated a pricing war. Shares of companies like Marathon Oil and Apache Corporation fell more than 40% on Monday, while ExxonMobil stock fell 12%, and Chevron slid 15%. Some of the companies that pioneered the shale boom, including Chesapeake Energy and Range Resources, were already in trouble, and their woes are likely to intensify. Chesapeake's stock goes for pennies, its bonds are trading at a level that reflect investor expectations of a default. Range Resources, an early natural gas driller in Pennsylvania, is, like many of its peers there, slashing its capital spending. That is likely to hurt the local economies in which the gas companies operate. Another reminder of how the economy is in danger of getting sucked into a steep, sinking spiral.